Hello, my name is Andy Hendren. I'm Associate General Counsel at the General Board of Pension and Health Benefits of the United Methodist Church, and we're here to talk about healthcare reform and United Methodist Annual Conference health plans. Today's agenda will cover the Affordable Care Act, a quick refresher. We will cover the near-term provisions of the Affordable Care Act that will come into place fairly soon. Then we'll spend the bulk of our time on the long-term outlook, the rules for 2014, and we'll finish with some illustrative examples to show you how it all works. The Affordable Care Act. The Patient Protection and Affordable Care Act, the PPACA, or ACA as it's often called, was enacted on March 23, 2010. It makes incremental plan and insurance market changes from 2010 to 2013 and then implements major reforms to the insurance market in 2014. The Supreme Court upheld the Affordable Care Act in NFIB versus Sebelius on June 28, 2012, in essence holding that the individual mandate was constitutional. But political uncertainty does remain, though a full repeal is unlikely. The near-term provisions of the Affordable Care Act coming in line fairly soon include the Summary of Benefits and Coverage, which requires group health plans to provide all participants uniform summaries of their benefits and coverage. There is a new limit on health flexible spending accounts of $2,500 that comes into effect January 1, 2013. Employers will be required to provide notices of exchange eligibility in March of 2013. A comparative effectiveness research fee will have to be paid by group health plans, which was roughly estimated to be $1 per participant in July of 2013. There are requirements for reporting quality of care by annual conference health plans or employer group health plans. Those are meant to take effect in 2013, but we have not gotten regulations from the federal agencies in charge, so we don't know when exactly those will come into effect. New non-discrimination rules under Code Section 105H should come into play in 2014 if the regulators issue guidance before that date. The other changes ahead include the exchanges, subsidies, and market reforms in 2014, new fees that employer health plans will have to pay for risk adjustment reinsurance on the exchanges. Employers will have to begin reporting the value of healthcare coverage on employees' Form W-2. Now, I have it as 2014 because that's the earliest possible date that employers in self-insured church plans may have to comply with it. Typical corporate employers actually will have to comply for the first time this coming January in 2013. 2015, large employers, those with 200 or more employees, will have to start auto-enrolling participants in their health plans. That should not impact the church world very much because there are very few employers that large in the church. In 2017, exchanges, the state health benefit exchanges, will open for large employers, those with 100 or more employees. And in 2018, the Cadillac plan tax will come into effect, which is an excise tax on plans that are too expensive. 2014. In 2014, the Act puts into place 4 interwoven parts to attempt to achieve near universal coverage in the United States. The first part is the individual mandate. Accompanying the individual mandate, and the mandate is that every American will be required to have health insurance or pay a penalty. Accompanying that mandate, in exchange for that part of the bargain, individual insurance market reforms take place, wherein health insurers can no longer deny individuals for pre-existing conditions. The health insurance exchanges will be established, and those exchanges will provide government assistance for those with modest income in the form of a premium tax credit toward the purchase of insurance in those exchanges. There will also be an employer shared responsibility provision, which is a pay or play rule, an employer mandate, if you will. And that is that if employers don't continue to provide coverage to employees, they will pay a penalty as part of this system to get universal coverage. In addition, Medicaid will be expanded. The Medicaid expansion. The Affordable Care Act expands traditional Medicaid, which varies pretty greatly by state, to cover all individuals at or below 138% of the federal poverty level. The federal poverty level is a term you'll hear throughout this presentation, and that is a number established by the Health and Human Services Department as the basic standard of living. 100% of federal poverty level in 2012, for example, is about $11,800. The Medicaid expansion would cover most Americans below the federal subsidy threshold, anyone below 100% of federal poverty level. That is its purpose. As you'll see in this visual, some states may opt out of the Medicaid expansion. That was part of the Supreme Court decision that I talked about earlier. One provision of the Act, the Medicaid expansion, was deemed to be unconstitutionally coercive on states. So states now have the option of not expanding Medicare as the Act provides. So, as demonstrated by this visual, in some states, those who fit in the yellow bars, those between their state's Medicaid definition and 100% of federal poverty level, may be without any coverage. So where do the states stand on the Affordable Care Act's Medicaid expansion? This map demonstrates where some of the states have decided to opt out of the Medicaid expansion, those in dark red. Some states have decided to opt into the Medicaid expansion, those in dark blue. Those in light blue are leaning toward expanding Medicaid. Those in pink are leaning against expanding Medicaid. The ones in pink and red are ones where employers, in considering what to do with their employee health plans, may need to think about very lowly paid employees may not have an option if their state doesn't opt to expand Medicaid. The mandate and market reforms. The mandate requires that all Americans have minimum essential coverage or pay an excise tax. In 2014, that excise tax is the greater of $95 or 1% of income. It is fairly modest. By 2016, it's fully phased in and will be $695 or 2.5% of income. It's indexed to inflation after 2016. Importantly, it does not apply to those who fall below income tax thresholds. If you don't pay income tax, you don't have to pay this excise tax. In exchange for the mandate, as I explained earlier, Americans will get a better deal from insurance companies. Insurers will no longer be able to deny or cancel coverage due to a person's health condition, so all coverage will be on a guaranteed issue basis, or exclude pre-existing conditions. Community rating provisions will also apply, which in essence means the oldest, sickest covered individual cannot be charged more than 3 times the premium of the youngest, healthiest covered person. The exchanges. The exchanges are competitive, regulated marketplaces for individuals and small employers to obtain health insurance. Exchange plan premiums will be subsidized with the premium tax credits that I talked about earlier for individuals with household income. And household income is an important concept here. Household income is defined as modified adjusted gross income. Modified adjusted gross income is really a number that one can figure out from one's tax return. It's adjusted gross income, the bottom number on an individual's 1040 form, adjusted, modified by a few additions. Additions such as tax-exempt interest and foreign earnings. But in essence, it's a person's adjusted gross income. Individuals with Medicare, Medicaid, or affordable employer coverage are excluded from these exchange subsidies. We'll get into what constitutes affordable employer coverage more in a bit. So who can access these exchanges? U.S. citizens and legal residents who are not incarcerated. Undocumented residents will not be permitted to purchase exchange coverage. Small employers can access the exchanges. They can, in essence, buy small group coverage through these exchanges for their employees. Importantly, individuals who get exchange coverage through an employer who adopts an exchange plan do not get the federal subsidies. They don't get the premium tax credits. Large employers will be able to access the exchanges later, at the discretion of states in 2017 and beyond. Who qualifies for premium tax credits? Individuals purchasing a qualified health plan, and that's an important concept to understand, a qualified health plan, a QHP, on an exchange who are not covered by Medicare or Medicaid, covered by another governmental program such as CHIP, TRICARE, or Veterans coverage, or they're not offered an affordable employer health plan that covers minimum value. Those two terms I'll get to more in the next few slides, or they're not enrolled in an employer plan, even if it isn't affordable. Minimum value. Minimum value basically says that an employer plan has to pay 60% of the total costs of a plan. That's an actuarial determination, but the plan has to be a 60% plan. The qualified health plans on the exchanges will be graded by valuable metals, gold, silver, bronze. A bronze plan is a 60% plan. So basically an employer plan has to be at least as good as a bronze plan on the exchange. Employees whose employer plan does not cover this minimum value can refuse the employer coverage, even though they're offered it, and go to the exchange, purchase a qualified health plan, and qualify for a premium tax credit. And the employer might get a penalty, but we'll talk about that later. Health flex plans and most annual conference plans, even non-health flex plans, should easily satisfy this requirement. Affordable coverage is a very important concept to understand. More important than minimum value, affordability is key to a lot of the provisions of the Affordable Care Act in 2014. An employee's required contribution, the employee's share of the premium, what they're required to pay for coverage, for participant only or single coverage, can't exceed 9.5% of their household income. Again, this is modified adjusted gross income, the concept I talked about earlier. So basically, the government has decided you're not going to have to pay more than 9.5% of your income for coverage in almost any place through your employer or on an exchange. 9.5% is a very important number throughout this presentation as well. Now, there is a safe harbor proposed where employers can rely on what they know about employee compensation, what they report on an employee's W-2 to determine affordability. But if an employee's contribution exceeds their household income, exceeds 9.5% of their household income, the employee can opt out. Again, they can refuse the coverage even though they're offered it, and go to the exchange, purchase a plan there, and qualify for a premium tax credit. Now, there's some uncertainty still as the regulators issue some guidance but are holding off on issuing more, and that is how this rule applies to dependent coverage. How much can an employer charge you, an employee, for covering your dependents, your spouse and your children, and it still be determined to be affordable for your family? Affordable coverage in the United Methodist Church, just as an example, 9.5% of United Methodist median compensation for clergy minus housing is $44,100 is median clergy compensation in the United Methodist Church. That's about $57,000 minus 13 or so in housing allowance. That basically means $4,190 annually is 9.5% of that compensation. That's $349 a month. If you charge $350 or more a month, on average, the coverage that the employer plan charges, the annual conference plan charges, would be unaffordable. Those clergy could opt out and go to the exchanges. Importantly, many conferences have structured premiums so that clergy pay very little for single coverage, so it will easily be deemed affordable for them, but they pay a lot more for dependent coverage. So again, what the regulators say about dependent coverage will be very important. The status of these exchanges varies greatly by state. Illustrated in this visual of the United States, again, the states in red have decided they're not going to have a state exchange. The states in blue have established a state exchange, the states in dark blue. The states in light blue are studying their options. The states in pink are sitting on their hands. They're not really doing anything. And the states in green have decided to joint venture with the federal government to do a partnership exchange. The states in pink and red that have decided not to establish an exchange or are doing nothing toward that, the federal government will step in and operate an exchange in those states. There will be a federal exchange for individuals in those states. The health insurance exchanges are, as I've explained in the previous slide, state-based or regional. They're a single risk pool, so there's a whole lot more lives in one pool of risk for the insurance companies behind it. Many states aren't ready, and as I said, the federal exchange will step in. Only insurance companies can offer coverage in the form of qualified health plans on these exchanges. The Health and Human Services Department issued a final rule on exchanges that did suggest that future guidance may cover church plans. So there is a possibility that church plans, like annual conference health plans or like HealthFlex from the General Board, may be able to be offered on these exchanges, but that remains uncertain. The Church Alliance, which is a group of CEOs of the major church pension boards, have submitted a comment letter to the regulators asking that church plans be allowed to offer coverage on these exchanges. The health insurance exchanges are, as I said, well regulated. The plans on the exchanges will be required to be offered on a guaranteed issue basis. So there'll be no pre-existing conditions denials. There'll be no pre-existing condition exclusions. Premium rates will be community rated, so their variation is limited. The maximum differential between the youngest person and the oldest person for these plans is 3 to 1. They can vary a bit by tobacco use, 1.5 to 1, and they can vary by family size and geography. That's it. They can't vary based on prior claims, on health costs, on any kind of pre-existing condition or genetic condition. Exchange plans will be offered at 4 different levels based on sort of Olympic medals, if you will. Platinum plans are a 90% plan. Gold plans are an 80% plan. Silver plans are a 70% plan. And silver plans are very important because they're really what will be considered the benchmark plan. Bronze plans offer a 60% coverage. The exchange plans are illustrated a bit further by this visual, and they're compared in the last column to a typical United Methodist plan. This is sort of the HealthFlex $750 deductible type plan. Basically, a plan like that compares to a gold plan. It's about an 80% plan. The silver plan, outlined in red, is the basis, the benchmark plan, and it's the baseline for determining federal subsidies or premium tax credits. The exchange premium tax credits are a very important concept to understand. Households, and again, premium tax credits will not be available to employees of plan sponsors adopting exchange plans as an employer. If a small employer adopts the exchange plan for its employees, those employees will share the costs with the employer as they would in any other situation now. If an individual goes to the exchange as an individual, not as an employee, then the premium tax credits come into play. So households with modified adjusted gross income between 100% and 400% of federal poverty level receive premium tax credits to purchase exchange coverage. This is to help affordability, to help make these plans affordable for individuals, again, to attempt to reach universal coverage in the United States. Federal poverty level is estimated in 2014 to be about $11,800 for an individual or $24,450 for a family of 4. 400% of that, 4 times that, which is the top level of income that still qualifies for some federal assistance, is $47,000 for an individual and roughly $98,000 for a family of 4. So some of these people are really middle class folks. Exchange premium tax credits. The premium paid by an individual or household is limited to 2% to 9.5%. There's that 9.5% again of household income. And that limit is regardless of the actual premium cost of the plan they purchase. What they're responsible for paying is only 2% to 9.5% of their income. Again, regardless of the cost of the underlying plan. Premium subsidies take the form of a premium tax credit. And a tax credit is an important concept to understand. They're claimed on an individual's tax return, which usually happens April of the following applicable tax year. The premium tax credits are refundable, so they can exceed your federal income taxes. What you qualify for in a tax credit for premiums exceeds what you owe in federal income taxes. You can get the difference back as a refund. But this still presents a timing or a cash flow issue for those needing assistance. The premium tax credits uniquely under the Affordable Care Act are advanceable, so they can be paid ahead of filing a tax return, up to 16 months before a return is actually filed. They're also assignable. An individual can assign them directly to an insurance company so as to reduce what they need to pay for the coverage. To illustrate what the premiums might look like on these exchanges, this visual may help demonstrate that. For example, at 250% of federal poverty level, about 4 columns down, An individual making $29,600 in income for a year will be required to pay 8.05% of that income for single coverage. So he or she will be paying $199 a month, roughly. This is an estimate of a silver plan premium. And the difference between that and the red number at the bottom, the red number at the bottom is the full premium, the actual cost of the plan. The individual pays $199. The cost of the plan is $650. The difference, $451, is picked up by the federal government. The federal government will pay that as an advanced premium tax credit on behalf of the individual directly to the insurance company. So how does this premium tax credit work? Here's where we're going to run through a few illustrative examples to help demonstrate how this works. Let's assume there's a United Methodist minister, Reverend Sam, making median compensation. So his compensation is $56,795. He has a housing allowance of $12,695. So his modified adjusted gross income, assuming he doesn't have any foreign earnings or tax-exempt interest, is $44,100. Reverend Sam has no employer coverage. His church doesn't offer him coverage. He chooses the silver plan through his state exchange. He cannot be denied due to his pre-existing condition. He qualifies for the premium tax credit based on income because his income is below 400% of federal poverty level. The premium for that silver plan he's chosen is $7,800 or $650 a month. He opts to have the advanced premium tax credit. The government will pay the insurance company on his behalf. So he pays $350 a month for his premium, for his single coverage through the exchange, through an EFT from his checking account or billed to a credit card. Health and Human Services will pay that silver plan insurance company $300 a month. So Reverend Sam's premium tax credit is $3,600. Another example of how the premium tax credit works is Reverend Cathy. Reverend Cathy has the same salary and housing as Reverend Sam. Plus, she has a non-working spouse and 2 children. Reverend Cathy has employer coverage through her local church. For that coverage, she pays $100 a month for participant self-only coverage. But she pays $900 a month for her dependent coverage to cover her spouse and children. Reverend Cathy's offer of church coverage is affordable coverage. She pays $100 a month, which is lower than 9.5% of her modified adjusted gross income, which would be $349 a month. So $100 per month that she's required to pay for self-coverage, for single coverage, being less than $349 a month, means she has affordable coverage, she cannot go to the exchange and buy coverage, and cannot get a premium tax credit. So Reverend Cathy's premium tax credit is 0. She's not eligible. What remains uncertain, though, is would Reverend Cathy's dependents be eligible to go to the exchange and receive a premium tax credit because the church charged her too much? It remains to be seen in future regulations. A third example of the premium tax credit is Reverend Lewis. Reverend Lewis has the same salary and the same housing allowance as Reverend Cathy and Reverend Sam. Reverend Lewis also has a non-working spouse and 2 children. Reverend Lewis has employer coverage through his local church, but the local church requires Reverend Lewis to pay $350 a month for participant-only or single coverage, and he pays $400 a month for his dependent coverage, for the coverage of his spouse and his children. Reverend Lewis's church, his employer, does not offer him affordable coverage. Now, why is that? Reverend Lewis is required to pay $350 a month for his coverage. That exceeds 9.5% of his modified adjusted gross income. That number would have been $349 a month. It's a close call, but his coverage is not affordable. What does that mean? That means Reverend Lewis can decline his employer coverage, he can refuse it for being too expensive, he can go to his state exchange, and he can choose a plan on that exchange. Let's say he chooses a silver plan. He qualifies for a premium tax credit on that exchange based on his income. The exchange will then contact Reverend Lewis's employer, his local church, and verify that he was offered employer coverage, but that it was too expensive. There'll be some sort of inquiry from the exchange to the employer asking whether or not the employer offered coverage to this particular individual and how much they charged him. And if the church is large enough and subject to the employer mandate, a penalty will be assessed by the exchange. So Reverend Lewis has gone to his exchange because his employer coverage was too expensive. He's chosen a silver plan on the exchange, which has a premium of $23,400 as an illustrative example. That's $1,950 per month. He opts to have the premium tax credit advanced and assigned to the insurance company. So he pays $230 a month for his premium to cover himself and his family. And HHS pays the silver plan insurer $1,720 a month. So Reverend Lewis's premium tax credit is $20,640. Now, reconciliation. Everybody who gets a premium tax credit through the exchanges, if it's advanced to them and assigned, they have to reconcile this on their tax return the following April. Advanced premium tax credit payments received in 2014 for Reverend Sam was $3,600, for Reverend Cathy it was $0, and for Reverend Lewis it was $20,640. So all three of these reverends have to file their income tax returns in April of 2015. They have to calculate what they actually qualify for in the form of premium tax credits, and it's calculated probably on some worksheet in their Form 1040. Based on the tax return, an individual's actual premium tax credit for which they qualify may be lower than what they were advanced in a premium tax credit, which is an estimated number based on prior year's tax returns. If there's an overpayment, if someone got too much tax credit advanced to them and they owe some back, they have to pay it back to the IRS. So we'll demonstrate this through a little what if. What if Reverend Lewis's spouse unexpectedly nets $18,000 in income in 2014? Reverend Lewis's modified adjusted gross income is higher than he expected. It's $62,100 instead of $44,100. So when he does his tax return, the actual premium tax credit for which he qualifies is $18,480, where he got $20,640 advanced to him in the premium tax credit through the exchange. So Reverend Lewis may owe the IRS up to $2,160. Now, premium tax credit repayments in this situation are limited by the statute for individuals who fall below 400% of federal poverty level. So in Reverend Lewis's case, he only has to pay back $1,500 instead of the full $2,160. But individuals who cross that 400% federal poverty line don't benefit from that limit and have to pay back the entire amount. Now, we're going to turn to the employer mandate. The employer mandate applies to employers with 50 or more employees. The employer must provide affordable coverage with minimum value, again those concepts we covered earlier, or else pay a penalty. Now this shouldn't apply to most churches. Most churches will fall well below this 50 threshold. There will be some churches, maybe a couple in every annual conference, that will be in this range, and there may be a few other employers in the annual conference that are affiliated with the church to which this may apply. But the vast majority of employers in the church are going to be smaller than that, and this won't apply. We're going to demonstrate this for those employers to whom it may apply. The employer mandate. Under the employer mandate, a large employer, for penalty purposes, is defined as an employer that averages 50 or more full-time equivalent employees. Full-time is defined as working 30 hours a week or more. Full-time equivalence is, in essence, aggregating part-timers. Part-time employees are added up to determine whether an employer is subject to the penalty. So 2 half-time employees would be the equivalent of 1 full-time employee, 4 counting up to 50. The control group rules apply, and that's a set of rules in the tax code under Code Section 414C that aggregates certain employers that are closely affiliated. Now there's a lot of uncertainty about how these rules apply to churches. There are rules about how they apply to non-church nonprofits, but churches have some particulars about how boards of directors and boards of trustees are appointed, and there's some uncertainty. So there may be some concern for annual conferences in how some employers, summer camps, foundations, and those sorts of employers relate to the conference or relate to a church with which they're affiliated. So the employer penalty. If an employer offers no coverage to its employees and at least 1 full-time employee qualifies for a premium tax credit, then the penalty is assessed at $2,000 per full-time employee, and this is a full-time employee. Full-time equivalents are not counted for adding up the penalty. They're only counted for getting to the threshold of whether the penalty applies. $2,000 per full-time employee is the penalty for no coverage, but it excludes the first 30, so you get a free 30. So if you have 50 employees, you don't offer coverage, and somebody gets a tax credit, you have to pay on 20 of those employees. If the employer does offer coverage, the second part of the penalty, if the employer offers coverage and at least one individual, even if it's only one, qualifies for a premium tax credit, then the employer pays a penalty of $3,000 per full-time employee that receives a premium tax credit. But the penalty under this provision can't exceed the penalty above. So the penalty for certain individuals receiving premium tax credits can't exceed the penalty for providing no coverage at all. The penalties are adjusted for inflation after 2014, and again, part-time employees are counted toward determining the applicability of the rule, but they're not counted toward calculating the actual penalty applied. Now, how would the second penalty apply to someone? That would be if an employer offers coverage, but for somebody it happens to be unaffordable, or if the plan doesn't meet minimum value. Then if individual employees run off to the exchanges and get premium tax credits, the employer may face some penalties, but not the big no coverage penalty. So to illustrate the employer mandate rule, we're going to run through just a few more illustrative stories. How the Affordable Care Act rule will impact 3 UMC employers: a typical local church, a large local church, and a large employer like a nursing home or a small college. The first of these stories is the typical local church. Let's say the local church, which is a small employer, has 3 full-time employees. It has 1 full-time clergy person, 1 full-time lay employee, and 2 part-time lay employees. So that adds up to 3 full-time equivalents. It covers its clergy person in its annual conference plan and its full-time employee in a local Blue Cross plan. It does not cover the part-time employees. If it decides in 2014 or later to stop providing coverage, to get out of the business and let its employees go to the exchanges, it will pay no penalty because it has fewer than 50 full-time equivalent employees. There's no penalty involved. If it were to offer coverage, it might pay an annual premium of, say, $16,000. What's that mean? That means there's a potential savings for not offering coverage of $16,000. But that's not the only thing that the small church needs to consider. The church needs to consider some other things in deciding whether or not to offer coverage, even with the existence of the exchanges and the option for employees to go there. Clergy may view this negatively. If a decision is made to stop offering coverage, for example, the clergy may pay a lot more for coverage on the exchange, especially if the church currently pays 100% of the clergy's premium, which is not atypical in the United Methodist world. The exchange plan may also be viewed as inferior to the current church plan, which are typically very robust and very well-rounded employer health plans. The local church may need to consider the mandatory versus voluntary nature of its conference's health plan. Some conferences require every local church or every appointed clergy person to be in the conference plan. In those cases, it may be a conflict between the local church and the conference as to whether or not the local church can get out of the health plan business. There may be an appointment concern for clergy and for cabinets if some churches are offering coverage and some churches aren't. The exchanges, however, do provide guaranteed issue access for the part-time employees. So it's a good thing for some of the employees because currently, in this illustration, the local church does not provide any coverage to the part-time employees. They will suddenly have a place to go to get coverage. And the exchanges may provide access for uncovered dependents. For example, if the plan doesn't cover an employee's spouse or dependents. The second example we're going to go through is a large local church. It gets a little more complicated as you add employees. Let's assume this large local church has 55 full-time equivalent employees, 6 full-time clergy, 4 half-time clergy, 30 full-time lay employees, and 34 part-time lay employees. This is a big church, say in a big suburban or urban area. If it offers no coverage, if it decides to get out of the business, again because it decides the exchanges are the way to go, it will pay a penalty of $12,000. That is 36 full-time employees. Remember, in assessing the penalty and calculating it, you exclude the part-timers. You count them to get to 50, but when you're calculating the penalty, you exclude them. So 36 full-time employees, and remember, you get the first 30 free, so you subtract 30 employees, you're paying a penalty on 6 people. $12,000 to get out of the business. And that's a penalty. That's just money to the government. It gets you no coverage, or it gets you nothing else for your employees. If the church decides to offer coverage, it stays in the business. It may pay an annual premium, for example, of $350,000 to cover all of those individuals. That's a potential savings of $338,000, and that's a lot of money even in a very large church budget. But again, the church needs to consider a lot of things besides the budget savings, besides the dollars, the bottom line. There are a number of considerations, including the advantage of, again, for part-time employees who may not be offered coverage by this local church, the exchanges provide an entry point for guaranteed issue access to health insurance and possibly government subsidies toward purchasing that insurance. Some of the lower paid employees may actually be better off in the exchanges. They may pay less. They may get greater subsidies from the federal government. But higher paid employees at the local church may not qualify for these premium tax credits on the exchanges. So if the church is getting out of the business, it may reduce the benefit for higher paid employees. In addition, those employees may ask for more pay to make up that difference. They may say, if you're not going to provide me employer coverage that you pay a good portion of, you need to pay me more, because if I go to the exchange, I don't get a premium tax credit, I have to pay the whole premium for my coverage. So you need to pay me more. That may reduce the church budget savings in the form of salary, but also tax obligations for the employer. Social Security and Medicare taxes, that's another 7.5% roughly. And clergy involved in this equation will pay more in self-employment taxes for higher salaries. Clergy may also view the no coverage option negatively. As in the small church illustration, they may end up paying more for coverage on the exchanges than they do now, because the churches pay most of the premium now, and they may view the exchange plans as inferior. A final illustration of this will run through the example of a large employer, a nursing home or a small college that has 215 full-time equivalent employees. They have 200 full-time lay employees, 30 part-time lay employees. That comes up to 215 full-time equivalents. If this employer decides to get out of the business and send all of its employees to the exchange, it will have to pay a substantial penalty. $340,000 roughly is 200 full-time employees, remember excluding part-timers, minus the first 30 is 170 times $2,000 per person annually, $340,000. If the employer stays in the coverage business, let's say its annual premium was running about $2,700,000 a year to cover 200 full-time employees and some dependents. The potential savings here is $2,360,000. But again, this is not done in a vacuum. This large employer needs to consider more than just the budget savings of $2.36 million. The $340,000, first of all, in penalty is money for nothing. It's just a penalty assessed to the employer, an excise tax paid to the federal government. The higher paid employees may not be premium tax credit eligible. The management at this business may not be eligible for premium tax credits. So they're going to demand higher salaries, which will also bring in more employment taxes. That reduces the savings. The $2.36 million will go down by what you have to pay people to make up the difference. Employee demographics are a key to this assessment as well. Employee income, employee family size, because those things determine who might be eligible for premium tax credit subsidies on the exchanges. There are also recruitment and retention concerns for employers who don't offer employer-sponsored health plans. If some employers offer employer-sponsored health plans that are offered on a tax-advantaged basis and may be more robust or maybe better than exchange plans, and some employers send employees to exchanges, there may be preference by some recruits, some potential employees, for the employer that offers an employer health plan. So there are some various employer options for employers to consider. They can, in this new regime, continue to offer coverage and provide affordable employer plan and avoid the penalty. Basically, this is status quo. This is business as usual. They can continue to provide an employer plan, make it a good plan, try to contain costs, and work under the old model. Alternatively, they could rely on the exchanges. They could terminate their plan, they could pay an applicable penalty if there is any, and remember there's none for small employers, and they could send their employees to the exchanges. This may involve paying some people, some high-paid people, a little bit more money, but it does save the costs of paying a premium for a plan or the costs of operating a self-funded plan. There's also a middle road to consider, and that is an employer might increase contributions for self-only coverage, for participant-only coverage to greater than 9.5% of income. Why would an employer do this? An employer might want to stay in the business of having a health plan for higher compensated employees who would not qualify for premium tax credits on the exchange. So it would keep an employer plan, but if it started pushing a little bit more of the costs to employees, and this would be across the board, it would be cost a little more for all employees, but those at lower income levels, it may actually end up becoming unaffordable for them. Remember, we talked about the affordability test earlier. If it's unaffordable for them, they can opt out of the employer plan. The higher paid employees can stay in it. The lower paid employees can opt out. The lower paid employees can then go to the exchanges, get federal premium tax credits for purchasing an exchange plan and have the option of choosing an exchange plan. This is a fairly complicated process, and we'll continue to try to educate the denomination about these potential middle roads. So a question comes up often about who is the employer in the United Methodist Church, and particularly for clergy. For most lay employees, it's pretty clear who their employer is. It's the person, the entity to which they report to work, the entity which issues their W-2. For clergy, they're appointed by the cabinet of the annual conference, but they report to work at a local church, and the local church typically issues their W-2. There's a very good faith argument that the employer for clergy in the United Methodist Church is the local church. In the Book of Discipline, clergy are deemed self-employed. In FICA and SECA laws at the federal level, clergy are considered self-employed. So neither of those leads to an answer of whether the clergy is employed by the annual conference or the local church. But it doesn't clearly decide which one it is. There's a tax court case out there called Weber versus Commissioner, where UMC clergy are considered employees for income tax and employee benefits purposes. So they are employees under the Affordable Care Act for benefits determinations. But the tax court applied the common law test of who's an employer. And most of the factors, or the majority of the factors in the common law test, would point in the instance of the United Methodist Church to the local church being the employer instead of the annual conference. It's a little bit uncertain, and the more we find out, the more we will share with the denomination. But for now, good faith argument can be made that the employer is the local church. In conclusion, it's important that you remember that the Affordable Care Act is a fluid statute. Right now, regulations are coming out fairly regularly, but there are a lot more of its provisions, particularly these big provisions in 2014, for which most in the industry are waiting for more guidance from the federal regulators. As more information comes out, and as more of these provisions become clear, we will continue to provide you with more information and more education and more illustration about how these provisions will impact annual conference health plans and the participants in them in the United Methodist Church.